Hello, everybody. So today I wanted to provide an update on STEM Inc. STEM is a stock that I've covered on the channel before. I haven't had an update in a long time, but this is a stock that's doing well. And I stumble across one of their latest presentation, and I see a lot of positive things that I wanted to report on. So if you follow him, it will come as no surprise to you that they expect to be EBITDA profitable in the second half, which is very good for this company because one of the main fears of the market is that they were going to run out of cash. In fact, they only had $138 million of cash on the balance sheet. This is a company that is very cash intensive because it installs megapack, and these cost multiple millions, 2 million, right, per. And so if you install a big project, megapacks is very cash demanding, and so a lot of people were worried that this company would go bankrupt, to a point that 29% of the float is shorted. There's 29% shorts on this company, which would have to be in the top 10 of companies that are betted against, which is so stupid. I mean, why would you want to bet against the future? This is not a dying legacy company. This is a company that is very forward-looking, with a very innovative product, and that is really moving us towards an era of virtual grids, an era of peaker plants that take the form of batteries as opposed to taking the form of natural gas or coal. So this is a company that has a lot going for them. I mean, don't forget, they operate the largest virtual plant in America. So much going for them. This is a company that's growing, predicted to grow at least over the next 12 months at more than 80%. And they already have a backlog of plus 88% year over year increase in their backlog. This is a company whose revenue quarter, if you compare second quarter for them compared to Q2 of 2023 to Q2 2022, there's been a 39% increase on their slow quarter. Like right now, this is their slow quarter for this company. We know that a lot of their projects are going to come to fruition in the back end of the year, and it typically does that. And this is a company that's been attacked. And this presentation I want to specifically report on because of this. This slide is actually amazing. You likely remember the short reports, that have attacked this company, saying, "Oh, well, they don't break out software and services, and we think they are lying. We think they're lying because they are grouping them together, and they really should not group them together." Well, they provided tremendous clarification in this slide, where they've put software on the one hand, services on the other hand. And I have a feeling that this slide right there, this clarification right there, was put just so that the shorts would stop attacking this company. And I think they did very, very well. Yes, it's true that they have some expert services for those battery energy storage systems that they install that include maintenance. It's true, but it's not as much of a margin as the gross margin business that's going to be 80%, as many of these battery storage systems are installed, and then they get a contract, a 20-year long-term contract for the Athena software that this company sells. That's why the title of the video is it a software company in disguise? Well, as time goes on, this company's revenue share will be more and more and more and more software, because you're building all of these installs. You're not making a lot of money on the sale of these battery systems, but then you make a lot of money on the software. So it's very similar to the razor and blade business model, where you don't make a lot of money on the razor itself, but you're going to make a lot of money on the blade. And in their case, the blade is the software that needs to be sold in order to make money off of your battery system, which is going to be those plants that mimic peaker plants, that allow you to charge, that allow you to buy energy when it's cheap and resell it to the grid when it's expensive. And there's another good point in this slide, which is something I had pointed out in a prior video, which is they're moving away from financing installs on their own. So you can see they added this category, and if you listen to the calls, you know that's what they're trying to move on. They're trying to move away from turnkey battery energy storage systems where they actually go out themselves and and purchase all of the hardware themselves and install it, and then it means that the capital, the cash, is gone for multiple months between the time this equipment comes to them and the time they install it and set it up and commission it and get the final payment. So that's why this is a business that they're slowly moving away from, and they're going towards a modular energy storage system. And the big advantage when you do a modular storage system like this is that you're much more integrated in the way you set it up with the utility, in the way you set it up with the industrial firm, such that you're only providing certain portions of the hardware, not the whole thing, not the whole system. You don't have to finance the whole thing, and thus your gross margin can be as high as 40%, which is something that we're very happy about. This is, as a whole, their hardware section. Not the reason why I think anybody would want to be in this stock. I don't want to be in this stock for the hardware business. I want to be in this stock for the software business. And frankly, I want to be in this stock because it's cheap. It's a very, very cheap stock, as we'll see in a second. Financial metrics. What are financial metrics? As far as the revenues goes, like I said, it's 39% year over year. What's very important is that adjusted EBITDA in the second half of the year. So we might see a Q3 with like a -5 or -3 million, and then hopefully you see -3 million in Q3 and +3 million in Q4, and that would make the company EBITDA profitable in the second half. And so this is very good, when and I have a lot of companies like that on my channel where you get into a stock right before it gets to EBITDA positive or EBITDA profitability. Typically the market tends to look at the stock more favorably, because once it is adjusted EBITDA profitable, once it is EBITDA profitable, the risk is massively reduced, because that company can't go bankrupt anymore, because EBITDA is a proxy for cash flow. It's very, very close to cash flow. And a company like STEM, cash flow is very complicated to look at, because it really depends on your quarter, it depends on your installs, etc. I also have a little bit of a second thought about the 13% gross margin. And this is something I've criticized before. And this is also something that, say, Tesla, for example, is heavily criticized on, even though Tesla has a higher gross margin than that. I think it's important to put it into perspective that when you have a very expensive product, it's okay to have a lower gross margin. Because would you ever have an 85% gross margin on a product that costs $100 a month? Or would you ever have a 13% gross margin on a product that costs $2 million? And obviously, as far as the margin goes, yeah, it's not as attractive. But as far as the profit itself goes, the profit is much higher when you do a multi-million-dollar install and you get 13%, as opposed to a whole bunch of $100 payments every month and you get 80%. If that makes any sense. And what you'll see oftentimes is that the market will punish these companies, which means that you can get that gross profit for cheap, as we will see in a little bit. So this is kind of a more interesting thought, in my view, on the gross margin of a company like STEM. And keep in mind, like, I took 13% here to make a point, but really, as you know, stock-based compensation really does not bother me too much typically in my companies. So really, if I were to look at this company financially, I would deem their gross margin to be closer to the 20%. We're at 18%. This is a company that is going to be cash flow positive, which means that their stock-based compensation should be decreased, because now they are not at risk of a bankruptcy anymore. So we should see those gross margins goes up, and that's the gist of this business. It's the whole idea of this business is gross margin are slowly going to go up over time as the hardware business is getting replaced by the software business. Let me move on to this. This was in the appendix of one of our later presentation. And this is fascinating, because this is a very complex company. You may remember when I started analyzing it for a channel, I made 4 videos. This is a complex company. And this really breaks down, feel free to stop, but it really breaks down where the revenue comes from in their business. And I think it's also interesting that she gets solar with this business for free. They just acquired Just Energy is the name of the business they acquired, which is a solar monitoring business. They sell monitoring terminals for solar installs, and then they sell solar services. So kind of the same business in both states. So, you have monitoring systems, and then once you have those monitoring systems, you attach the software. And I think this is very relevant for both of them. A company again that has its hands in very high growth fields, and I'll conclude the video on this on how growth the field is. So let's look at the numbers now. Let's look at the financials. They're reaffirming their guidance again, and we're in September. This is a September presentation. They are reaffirming it in September, so this is going to happen in my view. So they are saying for 2023 we'll have a full I'm going to call it 600 million, right at the midpoint, a full 600 million, a full 17.5% non-GAAP gross margin. I'm taking the end point of this. And this is great because you're going to see the growth number that this gives you is pretty high, pretty darn high. This is what I said about the back half of the year. Many of their projects come to fruition in their back half of the year. This is a company that has a tremendous growth runway. Look at the bookings, right? 1.5 billion in bookings, so tremendous growth runway right here. Adjusted EBITDA for a full year will still be negative, but when we go into next year, 2024, it will be positive, right? Second half will be positive, 2024 will be positive. So the market should re-rate the stock, reevaluate this stock. And this is the part that will grow. This is the recurring revenue. The recurring revenue is going to be at 85 million this year. So you could evaluate this company based on its recurring revenue too, and you'll see that it would be trading probably in line with your typical software stock if you were to just look at the recurring revenue. This is the share that's going to greatly increase for this company. I think it's going to be nearing about 20% pretty soon. But once we cross the 20% threshold, we're going to get 30, 40, 50%. And in my view, if one gives this company 5 years, in 5 years, we'll have greater revenue from the software attach, from that software attach rate on these installs, greater revenue than from the hardware itself. Let me conclude with the valuation. Thinking about this valuation. So STEM enterprise value is a 1.22. Knowing that there's been a lot of dips in the stock price, so you can oftentimes get this stock for cheaper if you're savvy in your buys and wait for dips. So 1.22 billion is very, very cheap for this stock, right? This is a stock that's trading at 2 times sales. That's still cheap in my view. Analysts predict 87% growth over the next 12 months. Gross margin is 17.5%. Like I said, this runs up to 18, and this gives it a valuation of 0.13. So in my spreadsheet, it would be a little more expensive than StoneCo. But when you get into valuations this low, really it's tough to nitpick. To compare, a Tesla is at a 0.7 right now, almost 0.8 actually, Tesla. So when you answer the question, how much am I paying for that growth? Each 1 percentage point of forward growth, you're paying a 0.13, which is about 4 times cheaper than the average stock that I cover on the channel. Such a cheap stock. And let me conclude with this, right? STEM is what? STEM is a bet on the future of energy storage, both for industry, right? And that will be front of the meter, what we will call front of the meter, for industry and for utilities. For utilities who are slowly replacing or inclined to replace their peaker plants, which are typically natural gas, but not only. Sometimes you have coal plants that are still prevalent in certain places. They're keen to replace these peaker plants by a bunch of megapacks that are operated by a software that is going to mimic mimic the 60 hertz that we need for the energy to get to the grid. It's a complicated field, and I don't pretend to understand it fully. Of course, I'm not an engineer, but that's the big thesis, the replacement of the speaker plants by megapacks. But not only. If you look at the front of the meter installs that they do, those megapacks that they install in front of the meter. And by the way, I'm saying megapacks as a generic term because yes, STEM and a lot of the competitive advantage of STEM is actually their relationship with Chinese company. But STEM, they're still a major installer of Tesla megapacks, and more than 50% of what they install is Tesla megapack. So it's important to note that STEM is an installer of megapack. It's a competitor of Tesla on the software side, because Tesla has Auto Bidder, and they have their own software, Athena, and Athena's Power Bidder. So it's a competitor on the software side, but it is a partner on the hardware side, because the main product they install is the Tesla Megapack, which is also an interesting thing to say. So for bigger plants, it's essential. Megapacks are essential for that, for replacing those. Megapacks are also essential for charging stations of EVs, especially trucks. Right, we know Tesla is working very seriously on a 750 kilowatt charger. Imagine that, 750 kilowatt charger. Right, it will make charging of a semi truck equivalent to charging at a gas station when you have 750 kilowatt charger. But of course, the grid is not built to handle 750 kilowatt chargers. So you need a megapack to power these chargers. And so that's part of their future. And these megapacks are essential for the future of the grid and energy trading and on-demand energy. And of course, to unleash the power of these solar fields, these large solar systems. I also love that they went into solar and not wind, because solar, in my view, it's logical why solar is going to win. Solar has very little maintenance. Solar does not have moving parts, and they went through solar. But solar problem is you have intermittent energy, and that intermittent energy means energy is very cheap during the day and very expensive at night when the sun is not shining. Well, this leads to the need for energy trading and the need to understand when energy needs to be stored and when energy needs to be sent back to the grid. That's called energy trading, right? We've heard recently Tesla's Auto Bidder software made more than 300 million in energy trading. So this energy trading is going to happen both at the residential level and at the residential level. As you know, I'm big on companies on this channel like Enphase, who I think are going to be providing the software that handles the residential level storage. But there's also going to be industrial level storage, and I think STEM, along with Tesla, is a company that is well suited to handle the sale of these energy banks, right? You can look at it as when you sell a battery to a large industrial facility, you are selling a battery savings account, an energy bank, an energy savings account is what you're selling. And that energy savings account can be used to strategically buy from the grid or sell from the grid, or strategically store the energy that you produce for your solar roof and store it for yourself, or store it in order to be able to resell it when there's peak electricity peak electricity prices. And I'll conclude with this. Remember, right now, in terms of revenue, this is a stock that trades a lot of narrative. So in terms of revenue right now, the narrative that is out there is, it's just a hardware company, it's horrible. But the hope as far as revenue goes, right, is that over time, this company will be defined by software and defined as a revenue-based company. But if you study this company a little deeper, we quickly realize that they are technically a software company that is being judged by the market as a hardware company, because that's where most of their business currently comes from. It's akin to the classic criticism of Tesla. Tesla is a car company, right? If you follow Tesla, you may follow Gordon Johnson. Tesla is a car company. 98% of the revenues of Tesla are because of their cars, right? Except the market is slowly realizing, oh, wait a minute. it's actually not a car company. It's actually much more than that. And I think STEM is a similar situation where the market is saying this is a hardware company. And what you realize is that no, it's not exactly a hardware company. They have a very, very, very strong software. The software has received many accolades from many different groups. Feel free to pause the video and look at all of these accolades. It's fairly impressive in my view. These are very respected fields. Like Wood Mackenzie is a respected consultant. Frost and Sullivan is a respected consultant. These are not, this is not some website out there. This is impressive in my view. And again, this is the crux of the business. This is how the business works, right? They do the hardware. They install the hardware. That's behind the meter projects. That's front of the meter projects. They're behind the meter projects. This is the low margin business. It takes 10 months to earn that low, 10-15% margin. It takes them 10 months to earn it. But then once they've done that, a year to as much as a year and a half after, once they've done that, they connect it to the grid, they do the permitting, they do everything. Then the software is turned on, and the software is turned on for 15, 20 years. The software will likely be renewed. So this is a SaaS company in disguise. And you can see for front the meter projects, you see it's even longer, as it can take 12 months and 18 months for them. So 18 plus 12, you can see how long this takes to turn on the software. But the software is getting turned on these systems. And when the software gets turned on, this is when the revenue mix for this company slowly shifts and slowly moves from hardware to software. So anyways, definitely a more speculative stock, a small position for me. And let me conclude by saying that this is not investment advice. This is just entertainment. I hope you were entertained. No investment advice here. I appreciate your liking my video. I appreciate your subscriptions to my channel. Thank you so much. Follow me on X too if you can. I appreciate that. Thanks for watching and have a wonderful, wonderful day.